Welcome in. This is the Fundamental Analysis Show where we cover a stock in 20 minutes, giving you a nice Sunday episode. Ryan is here with me today, and we are talking Sony, the Japanese conglomerate. We kind of got a Japanese tilt here the last, start here.
Because Buffett bought all those,
right.
What was it, Japanese companies, Japanese debt, something like that?
Whale wisdom. Yeah, we're looking at more conglomerates. He was in trading companies, so ancient trading companies, classic clickbait Buffett story, but that's not what the show is about. We're talking Sony, the conglomerate. So when you get into the history and then what Sony does.
Sony is one of the world's largest manufacturers of consumer and professional electronics. So even though they've produced the most successful console ever, which was the PS2, and they are the second largest video game publisher worldwide, Sony's actually not as cyclical as you might imagine. They've broken out their revenue into 7 different segments. So they have games and network services, music, pictures, electronic products and solutions, imaging and sensing solutions, financial services, and all other.
And then imaging and sensing, they say it like that, but it's mostly semiconductors. So at the start, you're like, oh, imaging and sensing, what is that? Think like semiconductor and adjacent stuff.
Okay, and they do a lot. They're a giant global conglomerate. Electronic products and game and network services are their largest divisions. So I guess TVs, consoles,
cameras,
game and network, basically the software component to the gaming and all that stuff.
Music IP, they own Spider-Man IP is their largest one.
That would probably be in music though, right?
Yeah, but they also own the Marvel. So Marvel actually doesn't own the Spider-Man part. Spider-Man is owned by Sony, so that's kind of like for some reason they own that specific one. And then actually they have 31 different companies. I counted them up in the 10K, 31 different. So it really is a classic conglomerate with just total random industries that they work in.
Interesting. Okay. History: Sony was founded in Tokyo, Japan in 1946, though it wasn't actually named Sony until 1958. They were started as an electronics store by Masaru Ibuka, and their big early product was the Sony transistor radio. Since then, they've built out tons and tons of different businesses that go under the Sony umbrella now. The Sony first went public or was made available to the public in 1955, and they listed on the New York Stock Exchange for the first time in 1970.
Wow.
Interesting note, though, Sony Financial IPO'd in 2007.
And now they're rolling it back in. So this spring, they're going to take that all in-house. It's kind of they're going to buy out all the outside owners and just make it a 100% owned company.
And then the only 2 major shareholders I could find were, of course, BlackRock.
Every time.
BlackRock Japan,
yep.
And some Japanese asset management company. Both owned roughly 5%.
All right, yeah, I'll get into the valuation because we could talk about the history for days. It could be a whole episode. So they have a $78.9 billion enterprise value, and that is estimated as of the recording date on October 1st. Their ticker is SNE, and I don't know if they're an ADR. I don't believe they are. I think they actually, because they do list on the New York Stock Exchange, it's not one of those weird international things where you're actually not investing in the company.
I thought they were.
Or they are an ADR.
I saw something on the Sony page that said they issued their ADR a long time ago.
Either way, it's a Japanese company. I don't want to stereotype them as being trustworthy, but I think you can trust them over a riskier Chinese company, which is where you worry about those ADRs a little more. The price, though, is $76.44 as of recording. They have a weird, with their financial services thing, that makes the enterprise value weird, and they also have negative $15 billion in net debt for calculating their metrics. So you got to put that in there just to actually get the real, valuation. They have an EV to free cash flow of 8.6, PE of 15.3, and then EV to EBIT, which is earnings before taxes, of 10.5. I like to do all 3 of those because sometimes they can massage earnings to make one look better than the other. You kind of want to see all 3 look good because it just gives you a better overview where you can maybe do an accounting trick and make someone think that your valuation is a lot lower.
Or sometimes it's not even an accounting trick. Sometimes it's just one-time blips that only affect one of those profitability metrics.
Right. And so all 3 of those I think are the best to look in tandem just because, a PE might look really low or really high, but in reality the cash flow is a lot better. Dividend yield right now is about 0.6%, so not strong, but it has been growing. They said they do want to grow it, and their buybacks have been small. Share count has been very steady. Trailing return on invested capital of 15.4%, which is good. EV to operating cash flow of 5.8. Free cash flow margin 12%. They have negative working capital, but they have done that for the past decade, and it hasn't been an issue for them. I think it's because they've been able to generate solid cash flow, and it's not too concerning when looking at their balance sheet. They do have long-term debt, but it is on a bunch of different years. It doesn't all go at one time, and it's not very large for the size of the company. Balance sheet is relatively complex. Again, it's a conglomerate, so you might expect that, and it's kind of something you're going to we're not going to go over every point on this on the show, but if you're going to invest, you're going to have to spend some time going over that to make sure you understand every part of the business.
All right, I'll dive into the earnings then. These are all basically trailing 12-month numbers, and then when I do the year-over-year metrics, it's the trailing 12 months from the year prior.
Okay.
So over the trailing 12 months, Sony has produced roughly $77 billion in revenue. That's down roughly 4% year-over-year. They had operating income of $7.9 billion. That's down about 2.5%. And then trailing 12-month net income was $6.1 billion. That was actually down 21% year over year. It's lumpy, and we're gonna find that and talk about that more. But there's a lot of lumpiness to the business, and then
especially in the COVID year.
Right, and there was $9.2 billion in short-term borrowings and $6.2 billion in long-term debt. Like you just talked about, their balance sheet was difficult to dissect, and it's not what you as an investor might be used to because it's Japanese documents, and it's like the 20F instead of the 10K,
and the financial part makes it so they're holding a bunch of marketable securities for their life insurance business. It makes things seem maybe a little worse or different than they are.
Right. They had 10% operating margins over these trailing 12 months. They had 8% net margins. Both are partially down from the year prior. Thought this was interesting, though. In 2012, they had 168,000 employees. Last year, they had 111,000 employees, a 34% decline in headcount. I'm curious how much of that is helping lead to since 2012, operating income has expanded.
Yeah, I'm curious and the margin's been a lot better, right?
Yeah, it's still lumpy somewhat, and you could pick random years and it might be off, but they are more profitable on a margin basis. I'm curious if that plays into it.
Maybe some automation. Who knows?
Yeah.
All right, welcome back from the ad break. First up here, this is one we do for the Fundamental Analysis Show. It is digging trenches, and that's just yes or no. What do you think? They got any moat competitive advantages?
It's 1 out of 3, right?
It's 1 out of 3. I forgot. Or you could say 0. Yeah.
Yeah. It's 3, I guess. 2. I mean, there's so many different businesses within the business.
I'd say probably 2.5.
Yeah, I mean, the console area, there's basically 3 players: the Switch, the PlayStation, and the Xbox right now. And unless cloud gaming really takes off and Stadia happens to be better than it is now, I don't see. It feels like they have a moat there. There's a lot of
definitely
tons of brand recognition with Sony. You kind of know what you're getting.
Music licensing is really, it's a moat because people are forced to pay, the royalties. Like, this is who Spotify has to pay all that money out to is Sony, and it's very high margin.
But there's also some of their business is sort of commodity products, like TVs, some of the electronics, headphones, stuff like that. I mean, the more the competition comes in, the more they have to lower prices or compete on price.
Yeah, so part of the business has a very high moat, and part of it does not at all.
All right. So I guess,
2.5.
2.5, somewhere in there. What about further reading?
Further reading, I wanted to look more into the images and sensing. So I kind of got the gist of it. They're like the number 1 brand for the specific niche of semiconductor and other products. Is kind of like computer vision, which could be a big growth opportunity, but it's hard to understand. You got to get down to the technical weeds there, and it's a business that isn't really intuitive unless you're big into the semiconductor and engineering industry. What part of the market are they focused on? I would kind of look into. I think they have automotive, and then in general, this is a highly complex company, so there's a lot of things we're not going to cover on the show here. There's just tons of further reading. For example, they just invested in Bilibili in China, and they now own 5% of that, and that's worth almost $1 billion. I think maybe like $800 million.
And what's Bilibili again?
I don't know. See, you got to look in to see what they even do.
Okay. Yeah, so mine's the financial services segment. They own SFH, which I didn't look up what it stands for, but it basically is their financial
Sony
company.
Financial Holdings.
Right. And then that engages in insurance, savings, and loans. Everyone knows banks ultimately use more leverage, and so it adds an element of risk to Sony as a whole. All of Sony's short-term borrowings, 90% belong to their financial services segment. Mm-hmm. So there's just a whole nother part that you have to analyze because it basically, I would say that's 90%, maybe 80% of Sony's risk or executional risk as a business in general, and it's all in their financial services segment. So you got to figure out what's going on there.
Yeah, definitely. And they're probably upset. They've been doing this for a while, and they're like, gosh, we're just in the worst interest rate environment like in history for Japan, specifically with those negative rates, basically zero rates for the last 3 decades. All right, future growth opportunities, what do you got?
Mine's the PS5. The PS5 is launching on November 12th. Last time they launched a major console was at the end of 2013, and the year following they saw a 14.3% increase in the top line. And that was the PS4, so that was the 4th best-selling console ever. So think about that. You had the 4th best-selling console ever, and it helped revenue jump only 14%.
It's because they, I believe they have really strong pricing power with that, right? They've had historically been able to raise prices. Is that true? Were you looking? I believe that's true, right?
It doesn't. It's crazy that something so big doesn't move the needle that far.
That's true.
But so more to the PS5, the pricing was pretty smart from what it looked like. So they have the one with the disc running capabilities will be $499, and the disc-free version is selling for $399. So they're probably making mild margins on the initial hardware sell for the $399 version, but the games will be software downloads, which are higher margin, and I imagine people are going to spend more than that $100 gap to buy games. So they're basically making up the margins later on in the life of the console.
And they have the PlayStation Now, which has 45 million users. So that's high margin as well.
Okay, and then it's just that's the cheaper way when you put a $499 version and then a $399 version. It's a cheap way to get into the households, and then you can make higher margins later on. Mm-hmm. Although Xbox is doing the same, but their digital-only version is $299. That's a little interesting. I'm curious if maybe Xbox or Microsoft is taking a bigger jump on the services side.
Historically, PlayStation's had more pricing power. Just from the console launches in the past, just people seem to be willing to pay more for PlayStations for whatever reason, which I guess is a good thing.
What's your future growth opportunity?
It would be the large investments they're making in the images and sensing business line for automotive. So this is a huge expense for research and development for self-driving cars. Companies are spending billions and billions on that. All different companies, from Tesla to the classic old companies in the automotive space. Everyone is investing in that because they know eventually it will occur. We don't really know when, but I think this could be a large part of that market that actually has profits flowing to it because there needs to be that imaging technology, and semiconductors are going to play a big part of that, and then there's also all the computing that goes with it. So it's going to take a lot of investment from Sony, but it could pay off, and it could be one of the few companies that actually has the technical specs to pull it off, so that with all their employees, you can't just have a startup to compete in that space. And it's also a little complicated. It might be a little over our heads and not in our specific niche that we like to invest in. But it's kind of a good, maybe a call option on this business because it isn't a giant part of their business right now as, Sony, the conglomerate, but it could eventually be if things work out.
That's the thing that I find so interesting is even if that's super, super successful, it doesn't totally transform the business.
No, but it's also on the flip side, it's not going to kill them if they don't succeed.
Right. What about your highlights and lowlights?
Okay, my highlight for me was as a conglomerate, their income is more stabilized when the macroeconomics change. So, for example, last quarter, gaming got a big revenue and income bump, but that was, able to offset the losses in electronics. And actually, gaming is, I think, usually the highest segment per revenue, on revenue basis. And last quarter was actually the majority of the revenue. So usually it's 30-something%, but it has gotten up to at least 50%. And I also like how their going to be absorbing their financial subsidiary as a wholly owned business. Just get that in-house. Why not? Keep everything streamlined. Lowlights for me, a lot of the products are hardware. Not all of it is, but hardware is harder to, margins are worse. It's a one-time buy, stuff like that. It's more hit-driven. Also, their IP stuff. Maybe are they just milking the streaming and music bump? Streaming video, streaming music. That stuff's getting a big bump right now, and Sony doesn't really feel like it's doing much on that. It still might work, but I don't know how much they're actually investing in that IP.
Also, if you believe that artists are going to move away from the labels in the future, that's a risk for Sony as well. My highlights, they aren't super cyclical. It's not like Nintendo, how they have one truly successful platform and all of a sudden it's a completely different business. So I guess it's not really that impacted by hit-driven events. But I'll bet most people do buy the digital-only PS5, and that should help margins, at least in the gaming business and potentially the business at large. My lowlights, though, it's lumpy and really unpredictable. The stock declined for 3 years after launching the PS4, which, keep in mind, was the fourth best-selling console of all time. It's hard for a big business like this to grow. There's a ton of different moving parts. Even huge console launches hardly move the needle for them. And that doesn't mean that they can't return value to shareholders through improved cost structures. But for reference, over the last 15 years, revenue has declined 7%, or at best is flat. And you can pick out independent points in time, but it's super lumpy. And I guess this will lean into our next question. I have no idea what the financials will look like next year.
Yeah, I don't know I think there's a floor. There's a high floor because it's not like every business is going to go away. But yeah, it's tough to analyze. You really got to dig in, and it might take a month to fully understand this business. So last question here. Are we more interested or less interested in Sony after today?
I'm not very interested in this company because of the lack of predictability on my part. I like a company where you can say, all right, they have, A, B, and C going for them. That should drive revenue, should lead to sustainable growth, and might change the margin structure or the margin profile for the business. It's hard for me to tell. Even if PS5 is a total hit and the software downloads change the video gaming margins, they could have a total drop-off in electronic sales and basically be flat. So it's really unpredictable on my side, and that's not something I like to see.
Yeah, I'm going to say the opposite. I'm more interested. I do agree with your points there, but the valuation intrigues me because I do think they have a high floor and that Sony is going to be able to generate lots of cash flow for years to come. It's not going to likely grow that much, but that's the conundrum you get into here. If you could invest in a high growth company trading at 100 times cash flow, or do you want to invest in a company trading at less than 10 times cash flow? You have to weigh those odds. And I don't know. I'm not an expert in Sony's business. I definitely have to read up more on them, but I am interested, and I would take a look, especially at this valuation.
It is worth noting they've been last year or 2 years ago, they had a free cash flow multiple about half of what they have now. So they have had a bit of a run up in the stock price as of late.
Yeah. Just because the cash flow multiple is fairly low comparatively, it doesn't mean it can go lower or can't go lower.
Right.
All right, that's going to do it for this episode, guys. Thank you for listening. Make sure to follow us on Twitter, as always, at ChitChatMoney, and email us at chitchatmoneypodcast@gmail.com for show suggestions. We love those. Remember, we are not financial advisors. Anything we say on this show is not formal advice or recommendation. Thank you for listening. We'll see you on our next episode.